So next up would be the term asset class. And this is really just a fancy way of grouping comparable financial securities or investments into buckets that have similar characteristics, laws, and regulations. So the different asset classes will be how financial advisors would manage your investing risk. So different asset classes tend to provide higher or lower market returns and are usually balanced by your financial advisor with bits of your capital spread across most or all of the different classes. So this brings us to the next big word, which is diversification. Diversification. This term is simpler than it sounds and is the strategy that a financial advisor uses by mixing your capital across the many different asset classes in the attempts to mitigate risk. So just by the act of doing this sharing of your capital across the different asset classes will smooth out the larger market swings that can be experienced by putting all your money in one asset class. So if the one asset class performs poorly, then your investment would perform poorly. Just the same, if that area does very well, then your investment will do very well. So diversification generally lowers your overall investment returns, but it smooths out the larger price swings over time. So this strategy is a great way to manage your risk when you're not confident on your investing decisions. The diversification strategy is very different for mutual funds than individual stocks. And this will make more sense later when you learn about the modern portfolio theory.
Wait a minute. I want to know, what is an index then, you ask? Well, an index is just a collection of companies calculated out to a single trading price. So there are several different indexes available to us and are generally used as a benchmark to evaluate an investment's performance against. So this helps you gauge if your investment in a company performed well compared to its peers in the field. I commonly refer to the S&P 500 index, which is commonly referred to as the US stock market because it consists of the 500 largest companies in the US stock market. The S&P 500 index is a collection of several companies and not necessarily any specific asset class to compare to. There's also the NASDAQ Composite Index, or IXIC, which includes almost all of the stocks listed on the NASDAQ stock exchange. This index, or stock exchange, is known for being heavily weighted towards the technology sector. Suppose you bought a tech company. You could compare the growth of that company to the tech index growth to measure if the performance was as good as it was for its peers. And you should know that each index is unique and has its own characteristics and methodology to create its value to measure against. So it's a good idea to know how the index is designed before you compare your investment to it. But hold on, I thought a mutual fund was just a bunch of companies. Kind of. Mutual funds can have indexes contained within them as well. Think of an index being a bunch of securities or companies all grouped together like a mutual fund, but the indexes adjust for different companies within it only once a year. The securities with an index need to meet specific criteria to be included in the index. And because the index is only adjusted once per year, they have very small management fees or costs to run.
Okay, now I'm super confused. What the heck is a mutual fund then? Well, if you think of a mutual fund, it can have an index fund within itself. Then you can imagine that they would have higher management fees or costs. So mutual funds are professionally managed by institutional fund managers and can adjust the holdings within the fund whenever they wish. They're essentially selecting assets for you based off of nothing but their belief or feeling that an investment is going to outperform the other ones. Mutual funds are publicly offered, and some are exclusive to only specific financial advisors with a firm or institution. And each of the mutual funds are unique to themselves and can consist of any number of companies or indexes in hopes to outperform other assets. They can contain any or every asset class and are usually quite large in size because they pool several investors' money together to make the fund. Later on, you're going to learn that this is harder to make the money the larger you are in size because you actually move the market price with large purchases and sales.
Lastly, for now, let's talk about what is a hedge fund. And a hedge fund is similar to a mutual fund in that it can contain just about anything within it. However, the main difference would be that it is privately managed and not publicly managed. So it's not necessarily open to everybody. And hedge funds typically outperform mutual funds, but they charge higher management fees because they commonly require a minimum investment of money or net worth from accredited investors. So that's it for now. I share with you these definitions now to keep you from drifting off as the lessons start to take shape.